those CDOs, and they are called credit default obligations. All right? Those CDOs which are sold out to the general public, underlying them are the actual mortgages, which are loans for the housing public. So those loans would look fine if nobody default on those mortgages. What happens was 2007, 2008, many of those housing loans, all right, are starting to show signs of default. And that's because people were very tempted to jump on this bandwagon of creating more CDOs. So even if you don't quite make the grade of qualifying for a mortgage loan, the banks are quite happy to lend it to you. So we are starting to get subprime debt. We're starting to get people who don't have incomes, have no collateral, and they qualify for mortgages. So therefore, you are starting to see that the quality on the balance sheet was getting to not quite the AA quality, nor BBB quality, but worse than that. So that whole machinery was at work. Then of course, as all of you know, the facts are there. The dark summer of 2008, I was teaching UBS in Sydney when we saw this news. The Fed have just come in, JP Morgan Chase, all right, have been tasked to buy Bear Stearns. Bear Stearns is a 100-over-year institution. So they say we cannot let it go under. So that was March 2008. Then of course, market panic literally fell off the cliff. When you look at Bambang's slides, you saw this downward movement in GDP. Those is what we call falling off the cliff examples. And that took place, that cliff was September 2008. Lehman was allowed to fail. When I was studying in New York City, everyone graduating from Stern wanted to join the banks like Lehman. It was like a big brand name. And the market gets this signal that the Fed is saying, it's okay, we will not save Lehman, let it go. Immediately, what do you think the mood in the market will be? What will the mood be like? I like interaction. So speak to me, Dennis. What will the mood be? Will you lend to any bank?
Yeah.
You won't. It's not just Lehman anymore. Banks started losing confidence in one another, and they just go, hold it, no more interbank loans. We are not going to worry about whether it's a strong bank, whether it's backed by government, whether you have FDIC. I see another counterparty in the interbank market. If it's an American bank, credit freeze. So literally the banks were not able to lend to each other. I was asked this question quite often. Dennis asked me earlier today, this morning, who is to blame? I don't think it's a blame game. I think the whole atmosphere was set up such that many people had a part to play in this whole mechanism. It started with easy money. So I think government has a big role in this. Easy money meaning that you are allowing for low interest rates, or you allow for a lot of money to be in the system. I think after September 11, 2001, there was a crisis within the US market. And so everyone wanted people to go out and play, go out and spend, and don't let that whole terrorism euphoria affect you. So Alan Greenspan had no choice. He lowered interest rates, and essentially to contain any sign of recession within the economy. So interest rates were very low. Many of us are actually looking towards the US for an interest rate policy decision. So the United States interest rate policy do percolate to the rest of the world. So everyone was seeing lower interest rates across the board. These low interest rates therefore make mortgages very affordable. I've been told that in the US market, you can go up to a bank and get a mortgage fairly easily. No down payment, all right? And guess what? If the whole interest rate environment is low, then it makes the buoyant stock market, it makes everything you touch look good. So the bond market, the stock market, commodities market, all give you the fixation that you are very wealthy. Things were moving up. So this low interest rates require that the business cost goes down. It makes asset classes look very attractive. And guess what? Investors have too much liquidity. So the opportunity cost of putting money in the bank is close to nil. what happens? Anything that looks like there's a tremendous upside, even if the name sounds like something you don't understand, you're attracted to it. It takes two hands to clap, my friends. So the investors were all looking for high-yielding securities. Therefore, there's great demand for all the CDOs coming up from the investment market as well. So all these CDOs were traded like stocks. Nobody really understood what goes behind the CDOs, but they were traded like equity, and high net worth individuals were told that this is fine, they are all well collateralized, please take them onto your books. So we have pension funds, we have people close to the age of 70 to 80 locked in on some of those instruments. Okay? And therefore the two scenarios are set up such that you have sellers of the CDOs, you have the buyers of the CDOs. Many of the Asian banks, I'm sure Indonesia don't have that many of them, but out in open economies like Hong Kong and Singapore, we actually have many of our distribution outlets from the local banks selling many of those structured products. With the housing boom, it all went well. Everything looks good. Then the riskier products were being created. So who is to blame at the end of that whole story? Okay, the subprime borrowers were making good with all the mortgages, and then guess what? The underlying housing that they have goes up in value. So they treat their house as an ATM charge. They go back to the bank again and say, I like new loans funded on this underlying mortgage. So you look at the balloon going up. So by March 2008, when Bear Stearns was sold, it was because Bear Stearns found that a lot of the assets on its balance sheet have gone under. They just could not, all right, support those assets anymore. We actually were seeing leverage up to about 33 times to 1. Debt was funding all those assets on the balance sheet. So September 2008 was critical, as John mentioned earlier. Lehman was allowed to fail. Merrill Lynch was acquired by Bank of America. Global stock markets went to that free fall, which you saw. Somebody asked me, then what has AIG got to do with this? AIG was issuing insurance. So the magic word there, back to basics, is CDS, credit default swaps. In many ways, it's an undertaking by AIG that if any of those mortgages go under, they will come in and take over. They will cover for the default risk of the underlying mortgages. So AIG was underwriting the risk, just like the Freddie and Fannie Mae. So AIG's total asset size shrank as well. They were marked to market, that's the concept. Somebody blamed marking to market. That cost a lot of the valuation to go under, and so of course we have a situation of salvage. Somebody asked me last night, who owns AIG now? Who owns AIG now? The American government. All right? Actually, AIG had to be salvaged with 85 billion USD line of credit. It came from the US government. So US government has 80% of the equity share of AIG. We now have a situation back by December 2008 of tremendous fear. The psychology of fear is very powerful. So here I talk about crisis. This crisis, unlike previous crises, all right, has such a tremendous psychological factor that government efforts alone cannot be enough. We actually found that in modern capitalist societies that we have today, credit is very important. I'm sure as players in the value chain of agri-commodities, you depend a lot on funding. And